our bet, and consider the source, our bet is staying away from these stocks now is going to end badly, and sticking with the benchmark. So they're running for their benchmarks because they think that's where safety lies. The benchmarks are what's going to be disrupted.
Hey guys, welcome back to Library of Wealth. ARK Invest CEO Cathie Wood gives us her market outlook for the next few months and discusses the lack of trust currently in many financial institutions. Wood believes that investors may now be resorting to keeping their money outside of the system and warns that we've never seen market volatility like this before. Wood believes that the Federal Reserve is not acknowledging the stress on the banking system. She says the Fed's plan to raise interest rates too rapidly is already a huge mistake, as it will risk tipping the economy into an unnecessary and deep recession. However, interest rates have increased 20-fold in less than a year, which has sent a massive shock through the system. Let's get right into the latest interview with Cathie Wood as she gives her market prediction for the coming months and what we can expect heading into the first half of the year. If you enjoy the content we do here, don't forget to hit the like button and subscribe to the channel. Let's get right into the video.
It has been much more fun than the last 2 years prior. Innovation was punished as soon as after COVID, people went back to work and supply chains, it was clear that this was really messed up and was going to be, and the debate around inflation and interest rates began. February of 21, we peaked, and we went straight down through December. And this year, I think partly because of ChatGPT, partly because more investors are beginning to tune into the disinflationary, if not deflationary, undercurrents at work in the market, and beginning to see, even if the Fed itself does not, beginning to see the other side of interest rates. I will say, as we look at the broad market, the narrowness, the breadth, it has dropped so significantly that many people are wondering about the true health of this market. Now, we think the resolution is going to be, and we're beginning to see it, as you say, in some of the less than mega cap tech stocks. We think the resolution is that the rest of the market will catch up if we're right on this notion that the big surprise, probably the biggest surprise out there for the second half of this year is deflation. If you look at the Bloomberg Commodity Price Index, it's down 29% year over year.
Oil stocks are the worst of the year this
year. Copper,
the
commodity with the PhD, is breaking down. And so I think we're seeing a lot of deflation enter the pipeline. And what the Fed is looking at, lagging indicators. I mean, horribly lagging indicators. M2 down 5% probably for May on a year-over-year basis.
Money supply.
Which
money
never
supply.
Happens.
China just
not
entered,
since the 1930s.
China just entered a bear market. And their economy is the slowest we've seen in our lifetimes,
the PMI came out today and was very disappointing. Right. Again, they exited zero COVID, and everyone expected them to create another commodity wave. That did not happen. I think the market is looking over the Fed, saying, wait a minute, there's so much evidence brewing here. Not only that there is deflation out there, but forgive me for using an identity in macroeconomics. It's very simple. It's an identity. And when people hear it, they say, oh, yeah, that could be the risk here. So what is that identity? MV equals PQ. PQ is nominal GDP, price times quantity, right? First quarter, nominal GDP was up 7%. Okay, so that's good. MV is money times velocity. The velocity of money is the rate at which money, at which it turns over. If you look at what happened in the first quarter, we know that M2 money was down 2% year over year. So what had to happen to get this 7% GDP? Velocity had to go up 9%, and it did. It's an identity. It had to. Okay, the problem now is we had a crisis, a regional bank crisis at the end of the first quarter. During a crisis, people pulled back saying, wait a minute, wait a minute, what's going on here? Especially when it involves the banking system.
Yes.
So
a financial crisis, not a weather crisis.
Exactly.
Right.
So second quarter, it looks like M2 will be down 5% year over year. And velocity, if we want to get the consensus nominal GDP numbers, 5 to 6%, velocity will have to be up 10 to 11%. It's not going to be. So I think that's why we're seeing some breaks here in pricing. I think that what is giving way is pricing, because the consumer has been saying, no mas, we're trading down, we are not. So I think that the margin pressure that we're going to see here is going to be serious, and an antidote to that is technology, AI, productivity gains. So I think innovation solves problems. I think that's another reason our stocks are doing well. It's very interesting. The bears in February of 21 basically said, this is nothing but a replay of the tech and telecom bubble. And they drew a chart from that point of the tech and telecom bust. And they said, this is where they are going to go.
I think I might have done that.
You might have done that. And that's what makes a market. And if you shorted us, you did very well. In fact, I think still 20% of ARKK is short. And so we actually declined more than the NASDAQ during the bust. Now, what's fascinating about that is we look at the period from 1980 through the tech and telecom bubble as the period when the seeds for all of the 5 platforms that I mentioned earlier, they were planted back then. But the technologies weren't ready. There was too much capital. I mean, the internet just captured the imagination, like ChatGPT is doing right now. The internet captured the imagination, and analysts started valuing companies on the number of eyeballs they might get in 10 years' time, something crazy like that. Too much capital chasing too few opportunities too soon. Why? The cloud didn't even happen until 2006, AWS. The first big breakthrough in in AI, deep learning, did not happen until 2012.
Right.
The second big one, transformer technology, natural language processing, which is ChatGPT, which is why we're going to see autonomous driving. That did not happen until 2018. Now we're ready for prime time.
She's identified 2 mistaken assumptions made by banks during the last 3 years, namely that they would be fighting a depression and that interest rates would not go up, which led them to invest in long-term securities. According to Wood, the Federal Reserve's quantitative tightening, where it is selling assets, has resulted in a decrease in the Treasury bond yield from 4.3% to 3.6% since October. She highlights that bondholders are the most focused on inflation, and managing long-duration assets is challenging when there is a fear of inflation and rising interest rates. On the other hand, she suggests that despite the Fed increasing the supply of bonds in the open market, the expected real yield has actually gone down. Wood believes that this is due to a flight to quality, where people are worried about the security of their assets and deposits in banks, leading to panic buying of government securities, pushing the price of bonds up and the yield curve down. What do you think about Cathie Wood's latest interview? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.